In modern cryptocurrency, the exact second a malicious transaction is confirmed on-chain, your capital is permanently gone. Look at this breakdown of total market losses versus recovered assets. That massive column represents billions stolen through rug pulls and exit scams, while this tiny sliver at the bottom shows the reality. Fewer than 5% of those funds are ever recovered. There are no chargebacks here. Decentralized finance operates completely without regulatory safety nets or customer support hotlines to reverse the damage. This table compares the basic developer exit scams we saw in 2021 with today's ecosystem. Moving through 2026, you are navigating a minefield of AI-generated code, highly convincing deepfake endorsements, and synthetic liquidity traps. Because your capital cannot be recovered, relying on surface-level hype or marketing promises will drain your portfolio. Protecting your money requires a new approach. Sophisticated traps are engineered to look identical to legitimate Web3 startups, right up until the moment your funds are permanently locked inside them. Separating genuine low-cap projects from toxic ones means you have to build an emotion-free, strict forensic framework to evaluate them. This creates a hard trade-off. You have to sacrifice the rush of getting in early. You must trade speed for security, forcing yourself to stop and analyze the underlying mechanics before you ever connect your Web3 wallet. Slowing down mathematically guarantees you will miss some rapid early price spikes, but it is the only effective way to insulate your core portfolio from total destruction. The first layer of this forensic audit happens before you make a trade. You have to expose the smart contract code, which often hides predatory mechanics behind flashy marketing. You do this by forcing every new token address through an automated contract scanner, like Go Plus Security or Token Sniffer. These tools instantly highlight dangerous code additions. They spot uncapped minting functions, where developers can print infinite tokens out of thin air, or modifiable taxes, where a project advertises a 0% buy fee on social media, but secretly retains the power to raise the sell fee to 99%. Running this scan adds about 60 seconds of friction to your process and requires learning a third-party interface. That 60 seconds definitively stops your capital from freezing in a honeypot. Trusting a project's bold claims about their tokenomics without verifying the source code is voluntarily acting as a victim. Next, you have to watch out for the Sybil wallet illusion. This is a deceptive tactic where developers boast that their total supply is fairly distributed across thousands of unique, independent community members. Use visual mapping tools to track funding origins. You'll find dozens of supposedly independent wallets were actually funded by the same exchange address simultaneously. This spiderweb radiating from a single cluster indicates the developer secretly operates those wallets to manufacture fake volume. Executing deep on-chain inspection takes time. It forces you to sit on the sidelines during the initial 10 minutes of a token's price discovery. But skipping this specific check ensures your retail buying power is doing nothing more than providing exit liquidity for early insiders. We also need to evaluate the project's base liquidity and how the total token supply is scheduled to enter the market over time.
Legitimate setups require clear on-chain proof that liquidity provider tokens are either permanently burned or locked inside a verified third-party escrow service for a minimum of 6 to 12 months. Look at this pie chart. It illustrates the hazard of a low-float, high fully diluted valuation model. Here, a tiny circulating market cap, just 0.5% of the total supply, is active, while the remaining massive allocation is locked up by insiders. When private venture capitalists and team members operate on short vesting cliffs, they unlock millions of tokens every 30 days, heavily diluting the public market and crushing the token's price. Strictly enforcing a rule against these low-float traps will shrink the pool of altcoins you can actually invest in down to a microscopic fraction of the overall market. Immense patience here prevents guaranteed dilution, preserving your capital only for setups that are mathematically sound. The final layer of deception usually involves hyper-complex technical jargon designed to mask entirely fake teams and impossible financial returns. You must relentlessly ask where the underlying yield originates and run reverse image searches on executive headshots to verify they are real people. This quickly flags AI-fabricated corporate identities. It also helps identify unsustainable Ponzi structures, where extraordinary yields are generated solely from incoming deposits of new buyers, rather than legitimate protocol revenue. Sticking exclusively to verifiable mechanics requires ignoring intense social FOMO and looking right past deepfake celebrity endorsements. A professionally designed website or an active live stream does not serve as proof of legitimacy in an AI-driven ecosystem. To make these on-chain lessons actionable, you can synthesize them into a rigid, binary decision-making tool, the 3-flag rule. This scorecard evaluates 6 core risk categories: contract risk, liquidity risk, distribution risk, team risk, tokenomics risk, and economics risk. Here is the scoring metric. If a project triggers 1 or 2 of these flags, you must proceed with extreme caution and severely limit your position sizing. If an altcoin triggers 3 or more of these core red flags, you immediately walk away. This scoring system operates independently of community hype. It removes dangerous emotion from the investment process and relies entirely on data. How you use this framework depends on your schedule. If you are a time-poor investor with a day job and limited hours to research, your path is simple. If you cannot commit to running this 4-step routine for every single trade, you should completely abandon the low-cap altcoin market. The risks are simply too high. If you are an intermediate investor, you have to embrace the intense friction of forensic analysis as your primary blueprint, holding your ground while the rest of the market rushes in blindly. Artificial high-pressure tactics, like screaming that there are only 50 spots remaining, are biological attacks engineered specifically to bypass your rational evaluation. Long-term survival in Web3 is not about catching every speculative pump. It is about preserving your core capital, surviving the traps, and waiting for true high-conviction opportunities.